Welcome back to part 2 of talking about the OBBB, which if you weren't here for part 1, OBBB stands for the One Big Beautiful Bill that was passed on July 4th. And appropriately, because of that, I am wearing the most American thing I have, which is my World Cup jersey. This episode, I'm wearing the 2022 United States World Cup jersey. And we will get into this One Big Beautiful Bill. And today we're talking about what it means for individuals. Last time we talked about some provisions for business owners, but today let's talk about what it means for basically everyone out there, but specifically doctors. Let's get into it. All right, we talked about this last time, but a couple things to make sure we're on the same page with. There's a lot of things in the One Big Beautiful Bill that basically kept things the same from the prior tax law. So the Trump bill that was passed in 2018 was supposed to expire in 2025, and a lot of provisions that were popular in that first Trump tax bill were made permanent in this new tax bill. But there was one big thing in the past tax bill that was very unpopular, especially if you live in a state with high income tax. And this was a limitation on the amount that you could deduct for your state and local taxes. State and local taxes, the acronym on that is SALT. So sometimes you'll hear, I see this like 10 years ago, when I first became a tax person, I learned what SALT was. I thought it was a funny acronym, but I never really heard it in like common term. But I feel like I started hearing this more and more when the first Trump tax bill was passed, and this state and local tax deduction was limited on your tax return to $10,000. Now, in a state like California, if you're a doctor and you have a house, you're probably paying $20,000 a year in property taxes on your house. You're probably paying $50,000 in state income tax. And so you're looking at $70,000 a year in state and local taxes that you would love to be able to deduct on your personal tax return. But the prior tax code limited that to $10,000. So there's basically this $60,000 that you lost out on as a deduction. Now, California and a lot of other states rolled out what are called these pass-through entity tax deductions. And that is still a thing, and you still probably want to do that. But this state and local tax deduction that was capped at $10,000 is now capped at $40,000. So it's a bigger benefit than it was before, but there's still a lot of people who are not going to be able to deduct all of their state and local taxes. And so you want to be careful and do the pass-through entity tax election if you're in this boat. So you want to know where, how much are you paying in state and local taxes, and, how close is that to the $40,000 mark? You also want to know what your total income is going to be, because if your total income is above $500,000, then you may lose out on some of this. The SALT deduction, the state and local tax deduction, will go from $40,000 down to $10,000, right? So if you're making $800,000, this $10,000 limit is still going to apply to you. So you got to know where your numbers are, and if you're even going to be able to benefit from this. And accordingly, again, you'll want to do that pass-through entity tax at the state level in your S corporation. Now, one thing that, as I'm talking about this, one thing that is kind of tricky about this tax bill, we haven't really talked about this, and it's a little bit of a tangent, but if you follow a tax law bill as it's getting written. I mean, I actually did an episode a little while ago on like one of the drafts. And I did predict it was going to get passed by the 4th of July. A lot of people didn't think it would actually get passed by the 4th of July. But what happens is there's all these drafts that get published, the House and the Senate, and then it gets edits and amendments, and it gets really confusing. And there are a lot of different limits, like the state and local tax limit. There were a lot of different variations on this. And sometimes when the final bill gets passed, people get confused of like, what was draft, what was final. The way they write it is not easy to follow. So over time, it all gets ironed out and we make sure we understand it. But right now, there's still a lot of raw things with the tax code. And the state and local tax is likely one of those. Okay, I'll go through a lot of these kind of quickly, just because there's a lot on here. Standard deduction. So when you file your tax return, you either get to itemize deductions, and that's where we get the property tax and home mortgage interest and charitable contributions, or you get a standard deduction. 2018, Trump's first tax bill significantly increased the standard deduction. It like doubled. So like a lot of people that were itemizing no longer itemized, and they actually got more benefit. Well, those high standard deductions were going to go away. Those are now made permanent. They also increased the tax brackets, meaning that you could make more income and be in a lower tax bracket in 2018, and they made that permanent as well. So there's a lot of people who were going to start to be in higher tax brackets, and that is not going to be the case. The current tax brackets are going to stay the same. There was a slight increase to the child tax credit. It was $2,000 a year. Now it's $2,200 a year, but just keep in mind, if you make more than $440,000, you don't get this. Now, there's an interesting thing that came out, which is these, I don't know, like the right term for this, but we're calling them like Trump baby accounts. Basically, what happens is if you have a kid who is born, well, there's a new type of retirement account for these kids, whether or not they're born in 2025. There's a new type of retirement account, and we're calling them Trump baby accounts. And it's like a traditional IRA, but it has some other benefits that are, basically trying to incentivize people to create savings accounts for kids, kind of like education accounts type thing. But in order to kind of promote this, they kind of have this pilot program. And if you have a kid who's born between January 1st of 2025 and December 31st of 2028, you can elect to open an account, and the government will put $1,000 into your child's account, which is great, except if you qualify for the child tax credit. My understanding, and again, this is one of those things, is maybe this will get clarified differently later, but this is my current understanding. If you qualify for the child tax credit, let's say you qualify $2,200 and you elect into the Trump account, then it reduces your child tax credit by $2,200. Now, to get that child tax credit, you have to have income. And so there's like, a benefit for people in low income that wouldn't otherwise even get the child tax credit to put that money into a child's account, which is great. But I think there might be a loophole, because if you make more than $440,000 and you have a kid, you don't get the child tax credit. You make too much money. But it doesn't say you can't elect into this Trump baby account thing. So let's pretend you make $500,000 and you have a kid. You're not going to get any child tax credit. So sorry, you make too much money. But you could put $1,000 into this Trump baby IRA on the government's dime, so you don't have to pay for that. So in the end, if you're planning on having a kid, or if you had a kid in 2025, or you plan to have one in the next couple of years, and your income is pretty high, this may actually not be a bad thing to get some free money into your kid's account. And I kind of like that it's like in the kid's account and earmarked for them. They can't touch the money or take it out until they're 18 years old. There's a lot of other nuances to these child tax credit accounts. Okay, student loans. So student loans, those get reported on your individual tax return. If you do qualify for deducting the student loan interest, most of you make too much money to really get any benefit there. But just one quick note on student loans. I follow the student loan planner, Travis Hornsby. Um, Known him for a long time. I think he puts out good content on this. So I'd recommend following him. But like from what I could tell on student loans, is it actually didn't seem like that bad of news. It seemed like a lot of things were like there are these new type of accounts and some different changes for new loans going forward. So, if you're going to be a doctor in 2 years from now, then like maybe that's not a good thing student loan wise, but who cares about those guys, right? They're not going to be listening to this. We only care about people who have existing student loans. And I don't think the news was that bad. Obviously, there's the Biden forgiveness of student loan thing, like the $10,000 and whatever. Like they eliminated that, but that honestly wasn't really going to benefit our doctors too much who have $300,000 of student loans. What was really going to scare us is eliminating like an income-based repayment plan. But from what I could see, it seems like it was almost more inclusive on becoming income-based repayment. You didn't have to argue a hardship to qualify. It seemed like it was like some good news on the student loan front, at least for people with existing student loans. Okay, charitable contributions. There's a little nuance there. We talked about the standard deduction being pretty high. So, like a lot of people, if you make a charitable contribution, you don't get any benefit for it because you get the standard deduction. But even if you do the standard deduction, you can still get up to $2,000 of charitable contributions, even if you're not itemizing. So, and there was something like this in the past too, but this is kind of a new thing again, which is good that you can get a deduction for your charitable contributions. Kind of not a great news is that home mortgage. If you have a mortgage and it's more than $750,000, you don't get to deduct the interest on that mortgage if it's more than 750,000. That was something that was introduced in 2018. It used to be $1 million, and that $750,000 is made permanent. So just keep that in mind. There is this really weird thing if you itemize on your tax return. So if you have a lot of taxes and charitable contributions and you do the itemized deductions, there's this weird 2/37 limit if your itemized deductions are pretty, like if your income is pretty high. Just know it's going to get watered down a little bit if your income's really high. The calculation's kind of funky. I'm not sure if it's worth going down that right now. And the last one is a surprising one. At least a lot of the people that I read from were surprised to see this. But if you have a car loan and it's not a business car, which a lot of our doctors put their cars on the books and deduct the interest on those car loans. But let's say it's a personal car loan that's not on the books of your business, or you don't have a business, you can deduct up to $10,000 in car loan interest, which is great, right? Let's go get some loans and buy some cars. But if you are married and file a joint tax return and you make more than $200,000 of income, you don't get it. If you're single and you make more than $100,000, you don't get it. So honestly, I think this is worthless for most doctors. I probably shouldn't even talked about it. There's some other things I didn't talk about as well, like, no tax on tips. No doctors getting paid tips. You don't pay your staff tips. No tax on overtime. You will have some people on overtime. But yeah, those are the biggest things for individuals. So maybe it doesn't feel, again, this is how I felt at the end of the last episode. I just felt like anticlimactic. It's like, oh, there's this big tax bill. It's so big. I'm wearing my soccer jersey, like I don't do that normally. But then at the end, it's like, a lot of it is just that there was stuff that we had last year that was good and it's sticking around. And that in and of itself is a pretty good thing. All right, hit me up if you have any questions about the One Big Beautiful Bill. I'd love to hear it. You can always reach me at travis@gouluru.com. That's GOULURU.com. Would love to have any questions that you have about the One Big Beautiful Bill. And thanks so much for listening. and hope to see you next time.